Hey everybody, welcome to the Head Startup. Let's get straight into it today. So let's say you have some of money that you want to invest in Bitcoin. So what is the best strategy for this? Are you better off to just lump all your money in at one go at one particular time into the market? Or is it a better strategy to invest, say, 20% of the cash you want to invest today, another 20% next week, and another 20% the week after, and so on? So that's a strategy called dollar cost averaging. And that's particularly what I want to focus on in today's video. I want to see, is this an effective strategy to use while investing in Bitcoin? So in this video, I'll go through when is a good time to use this strategy, and I'll also look at a specific period of time. I'm going to take the month of January and show you the figures on how it would have worked if you had used this strategy for the month of January 2021, that is. And lastly, I'm going to show you on a chart basically over the last few years when this strategy was effective and what times it wasn't effective. So then basically you can decide for yourself whether this strategy might be a good idea for you if you are deciding to get involved with Bitcoin. So dollar cost averaging is basically a strategy to reduce the impact of volatility. So for instance, this strategy really suits a situation, say if you're buying into a stock and you're worried that it could be overvalued. So you're buying in and you're worried that it could possibly tank as soon as you buy the stock. This strategy will even out all the short-term fluctuations up and down, so you'll buy in at a nice kind of average price. It won't be the best price, but it will be a nice fair price. And here's why I think this ties in nicely with Bitcoin. So when most retail investors become aware of Bitcoin, it's already on a run. It's probably even close to its all-time highs. I find that a lot of people I talk to who are only getting into it for the first time, so they're buying it near its all-time highs and they're looking back at the charts from the history of Bitcoin and they're seeing all the crashes and what happened. So they're worried about getting in at a really high price and it just tanking immediately and losing all their money. So in the next part of the video, I'm just going to show you the numbers behind all of these different strategies. The dollar cost average strategy versus buying in with a lump sum. For my example, I'm assuming that a person is going to buy one whole Bitcoin. Okay, so firstly, let's look at the pricing chart for Bitcoin for the month of January. So this is all priced in euros here at the moment. As you can see, for the whole month, it's been very, very volatile. So we were seeing highs of the kind of 33,000, 34,000 range, and then it's also seeing lows of around 22,000 per coin. This is coming directly after a month of December 2020 when Bitcoin was on a massive bull run and reached some of its all-time highs. So you can imagine as a beginner investor, you're looking at this chart, you're looking at all this volatility, and you're thinking to yourself, how am I going to time the market? How am I going to get in at a really good price here? It's changing so much hour by hour, there's massive fluctuations. Okay, so firstly, let's look at the lump sum investment on its own. So obviously your best case scenario was buying in when the price was at its lows there back on the 2nd of January of 22,016 euro. And the worst case scenario is you would have bought in roughly around the 25th of January when the price spiked to around 33,890. So there's a massive range between these two different prices. You'd be really happy with yourself if you bought in at 22, and you'd be really sickened with yourself if you bought in at 33. But that's kind of the risk with your lump sum investing, is you're just picking a point in time and you're hoping that it just trends upwards from that. But when in a time of volatility, when the price is going up and down the whole time, you can easily lose a lot of money by just picking at one particular point in time. Now let's just compare this to the dollar cost averaging strategy and just see how the figures look compared to that. So for this, I've assumed we bought 0.2 of a Bitcoin every week for 5 weeks. So as you can see here, on the 31st of December, we bought in at 23,000 for 0.2 of Bitcoin, and then on the 7th of January bought in at 31,000 for 0.2, and then on the 14th it was 32,000, and 21st of January it was 25,000 almost, and 27th it was 25,500. So that gave us an average price of 27,539 for one whole Bitcoin using the dollar costing average strategy. So obviously, as you can see from using this strategy, you get a nice kind of blended price for the month of January. You're certainly not overpaying for Bitcoin, and you're certainly not getting in at the very best price possible, but you're kind of getting in at a fair price. And it also gives you a bit more control, maybe to buy a little bit more when the price is lower, and then to buy a little bit less when the price goes up. And that way you can make sure that you're constantly getting in at a decent price. So here is just kind of a summary of basically the best case scenario, the worst case scenario, and the dollar cost averaging strategy. So as you can see, you're kind of falling somewhere in the middle, which is not a bad place to be. And obviously your results will be completely different depending on how long you spread your investment over and also what particular time you spread it over. So this strategy is only really effective when there's a short-term kind of stabilization, but it's still very volatile. When you compare this to a situation where the price is constantly rising, then a dollar costing average strategy would not be the most effective. Lastly, I just want to show you how dollar cost averaging as a strategy would have performed over the lifetime of Bitcoin. So these statistics are coming from medium.com, and these statistics only go up to, say, the end of 2018, kind of start of 2019. So it's not the whole picture here, but you kind of get the idea. So but basically from this chart here, you can see any section that is highlighted in green here is where dollar cost averaging has outperformed lump sum investing as a strategy. And vice versa, any section here that is highlighted in red is where lump sum investing has outperformed dollar cost averaging. This really highlights the strategy that dollar cost averaging is only really an effective strategy when Bitcoin is kind of in a state of high volatility, kind of reaching its all-time highs and starting to crash. In that kind of a situation, dollar cost averaging outperforms lump sum investing. You should take this into consideration if you're deciding to implement this strategy. Have a look and see what the volatility is like at the moment, where the price compares to its all-time highs. If the trend is in a gradual increase, you're going to be better off going with your lump sum investing. But in a time where there's high volatility and there's lots of ups and downs, dollar cost averaging will outperform lump sum investing. So let me know in the comments if you've tried out this strategy before and how you got on with it. And also, if you enjoyed the video, I would really appreciate it if you gave it a like and gave me the subscribe so you see more future content like this.